There is one part of my system that created my 3 best trades from this past year, and that is my protocol around daily consolidations. And that's what I'll be talking about here in this video. I'll go through each trade top to bottom and explain the 3-step process that you can follow to not only avoid unnecessary losses within consolidations, but also how to anticipate and catch these same trades for yourself in the future. The first step of this protocol is actually identifying that the market is trading in a consolidation range. Taking a look here at the daily time frame, what you're going to notice when the market's in a consolidation is when you look left, off the highs, there will be failure swings, and off the lows, there will be failure swings. When there are failure swings to both sides of the market, that means there is not an established point of reversal to either side that can be traded away from. This means the market is completely neutral at this point, and this leads me into the second step, which is arguably the most important. The first thing I do when I notice the market is in a consolidation range is noting the highest high and the lowest low and marking those 2 points out. We can call these 2 points the external high and the external low. All it is the extremes of the consolidation range, the highest high, the lowest low. That's where we want to have our focus. That is what is relevant in this stage in the market. And anything in between these 2 points, we consider internal range price action. This is where the part of avoiding unnecessary losses takes place. And this is where you can either make it really simple or really difficult on yourself. If you want to make it simple and you want to avoid the unnecessary losses, avoid trading in between these 2 points. Remember, these are all failure swings to the relevant swing on the external side of the range. So they are not going to offer, one, very high likeliness to put in a point of reversal, or it's going to give you false signals. And the other is that when we're in between these 2 points, ranging in a consolidation, you're unlikely to get a directional expansion daily candle. It is going to make it very difficult to capture a good trade. So we're just going to simply avoid it. We are playing the waiting game, mark out this high, mark out this low, and until it reaches one of those points, we are waiting. And that leads me into the third step. This is where I start to form a bias based on how this daily candle reacts off of the external low of this consolidation range. And we can also see how these days continue to be indecisive, smaller range, and overall unfavorable trading days. And that's where we come into the part of avoiding unnecessary losses. Once it reaches that external low, I start making a judgment call and forming a solid narrative around what should happen here. And really one of 2 things can occur. This will be the first example for this trade. The next 2 trade examples will go over the second type. But what I see here when the market trades into the external low, it runs down into it and then turns back higher to close back into the range. That means it's a manipulation of this external low, which is relevant in this context. So I'm building narrative around this consolidation. I understand that this low does not need to be traded back to, and the market should then start expanding to the upside into this external high, which is acting as a draw at the opposing side of the range. You now understand the first 2 steps of the consolidation protocol. Those remain consistent across every scenario in the market. You understand the first part of the third step, which is a manipulation of the consolidation. And the second type will be in the following trade examples. But I want to go through each trade top to bottom. So I'm going to break down how I took a confirmation and my entry on these trades. Refining this down to an hourly time frame, we can see where the market dropped down into the external low, returned back up and closed in the range. Now the confirmation to this bullish bias is a bullish daily profile on the following days. So this day did not necessarily confirm it, but it opened low and closed higher, forming an up close daily candle. The bias is still valid, but wouldn't have offered an entry. We're going to roll over that into the following day, still looking for that expansion to this external high. I'm also going to look into the previous day because there is a down close candle that was closed above. That should be respected in this continuation to the upside. So when I'm looking for this bullish daily profile in the following day, I want to see it remain in respect to this area here as well. Here on the 30-minute to view the daily profile, we have the opening price of this 4-hour down close candle. Remember, we want this to be respected in the continuation higher, and I want to see a bullish daily profile develop alongside that level. The market opens up, drops down into it. The first signature off the lows, there is a divergence. There is a higher low on NQ. We're at this same point. ES made a lower low. That is one confluence that this is a reversal taking place. There is a series of down close candles closed above here. That is a change in state of delivery. That means this low intraday no longer needs to be traded back to. And when we have a new down close candle retesting that area and a new close above, this is a continuation signature, which I can act on as an entry. I understand that the lower wick of that daily candle has already formed. It is a London reversal. That means New York should be a continuation to the upside into the external high of the consolidation range. With the close above confirming this down close candle in the continuation, that is my entry. I'm expecting that the market has already put in a low of day, is in that continuation, forming the body of that expansion daily candle. And we can see it continues through New York as suggested by the daily profile. But when 930 comes in, that's what really pushes price to the upside, bringing that volatility and speed into the external high where I fully close out that position. Moving on to the next trade example here, this is where we'll get into the second way that the market can leave a consolidation. But first, before we get into that, we need to address the first two steps. The first step is identifying that the market is in a consolidation. The lows have failure swings, the highs have failure swings, no established point of reversal. The market is neutral. And also, if we just generally look at these daily candles, they are very indecisive, smaller ranged, and that means we want to consider it a consolidation. That leads me into the second step, which is looking left to the highest high, annotating that out as the external high, the lowest low, marking that out as the external low, and waiting for one of those 2 points to be engaged by the market. This indecisive daily candle would have been avoided because it remained internal in between the external high and external low, but the following day traded into the external low. However, the difference from this first example is that instead of running into it and then trading back and closing into the range, it had a deep close below the external low. This means it is not a manipulation to draw back into the external high. Instead, that close below means we're looking for a continuation lower and for price to expand below that point. It's important to understand that the characteristics of a manipulation is that the market is going to draw into it and then almost immediately turn back higher because we are drawing from the extremes of the range. There is nothing beyond that point for the market to reach into past this low. So once it trades into it, if it does not immediately react and close up into that range, we are acting as a continuation and we are looking for that to continue lower. Viewing the same area on the hourly time frame, we can actually see where the market attempted to manipulate this external low multiple times, but failing to do so, forming this up close candle and then closing below. So we have a close through on the daily, but also a close below on the hourly time frame of this up close candle. That is another continuation signature acting in confluence that this should be a continuation to the downside outside of this range. That means for the following day, my bias is bearish and I'm looking for a bearish daily profile to confirm this idea. Going into the New York session, I'm looking back on the overnight price action and asking myself, is this confirming my idea to the downside that I set in the previous day within this daily profile? And here I can say it is. We have this close below from that up close candle on the hourly. And from the daily open, the market is already starting that continuation lower, and I still have objectives below to fulfill. So I'm going to be looking for that first continuation signature, and that will act as my entry on this trade. Looking in this area here, we have a close below these up close candles when I'm expecting a continuation to the downside. That's great. That's the first thing I look for, but I can pair this with other confluences to make this a lot more confident entry for myself. The first thing here is I'm using a relative higher time frame. So this is a 30-minute chart. When I get that signature offered on an intraday basis, that is offering something that is really significant to me. The other is that this high here is a lower high on NQ when it's a higher high on ES. That means this is a divergence and this is the weaker pair here, which is good to be shorting on. And the third is that at this candle here, if you notice it's at 8:30, there was a news event at this time. So I'm also pairing it with a volatility driver. That is 3 confluences alongside the basis of a close below these up close candles. While the narrative is bearish, that is everything I need to take a very high probability entry. My stop goes above this high and I'm looking for that price to continue to the downside. With that entry, the market continues to the downside and the volatility drivers help out a lot with this move. 8:30 puts in a short-term high. Then we have 9:30 acting as a continuation lower. You can really see when we compare this New York session price action in comparison to the overnight price action, it's obviously a lot faster. And this is where I really like to be participating, taking entries, holding my trades, because a lot of opportunity exists here. And on the screen now, you'll see my executions for this trade. Moving on to the third and final example of this video. This is not only one of the largest trades that I've ever personally taken, but this is also the largest point range day ever in the indices market. So this is a pretty fun one, but we're going to go through it in the same exact steps as the previous trade examples to show the consistency across any market in any significant scenario. So the first step here is looking left and identifying that the market is in a consolidation range. There are failure swings off the highs, failure swings off the lows. I understand that this is a consolidation, and the protocol begins and we move into the second step. The highest high is the external high. The lowest low is the external low of this consolidation range. Anything internal is avoided, and we can see how there's a lot of back and forth price action that we do not want to participate in because we're avoiding these unnecessary losses that can take place. We're waiting for the market to trade into one of these 2 points, and that is where we're going to start thinking about forming a bias and looking for a potential trade. The following day, the market reaches down into the external low of that daily consolidation. This is where I can start thinking about potential participation. Is this offering me a bias? Now, the one thing that this differs in comparison to the previous example is that I am not waiting for the daily close here, because this day has a high impact news driver and it expands very aggressively in a very short period of time to make an assumption that this is not a manipulation of this external low. It is likely a continuation considering how deep it traded below. There is FOMC press conference on this day. That means I'm not participating in any hours prior. 14 is the first driver of the day and 14:30 is the second. I always wait for 14:30 before thinking about putting on an entry. So at this point, I have a bias for a continuation lower, an alignment of a daily profile with a high already in place, and I'm simply looking for a continuation through the external low, continuing to expand to the downside. Once the time hits 14:30 on the open of this new candle, I can start to consider if I have an entry within this range. And you see this signature I continue to repeat within this video when it comes to entries. There's a close below this up close candle now on the 5-minute. This is something that is significant and is offering me a potential entry because the narrative around it supports the idea. I've gone through the consolidation protocol. I've addressed the higher time frames. I've confirmed that this is a continuation lower based on this high impact news event, a volatility driver. That all makes this work here. So it's very simple, but I've done all the hard work already. So this close below offers me an entry with a stop loss at that high, expecting the market to continue to the downside from this point. Following this close below here at 14:30, which acted as my entry, the market continues expanding lower. That is the narrative that we've set before following through. And what you may notice is I entered on this close below here, but anytime we created an up close candle within this continuation, once it was closed below, the market did not return back to that high. That is a signature that is exclusive to expansion markets, and that's why the higher time frames are so important. So while this played into my entry, this played into my trade management. I didn't need to expect this size of a move, but my trade management protocol, understanding what this means here, allowed me to participate in a move of this size. To recap everything I just went through in this video, the first step of a consolidation protocol is actually identifying that the market is in a consolidation in the first place. There will be failure swings off the highs, failure swings off the lows, and that means the market is completely neutral. The second step is marking out the external high and the external low, the highest high and lowest low of the range, and waiting for one of those 2 points to be engaged. Anything in between there is considered internal and should be avoided. The third step is once the market trades into the external range, you are making a judgment based on what it does and how it reacts for what it should do next. If the market trades into the external range, wicks it, closes back into the range, that is a manipulation, and the opposing side of the range becomes a draw. If it closes through the external range, that is a continuation signature to continue expanding through that point. I hope you can apply this consolidation protocol alongside the confirmation and entry pieces shared in this video in your own trading. And if you found this video helpful, let me know down below, and I will see you in the next one.